Hi there, I'm champion trader Kevin Davey, and today we're going to talk about how to trade futures responsibly by eliminating 4 trading traps that you might be falling into in 2024. So let's get started. First, our disclaimer, U.S. government disclaimer: don't trade with money you can't afford to lose. Past performance is not indicative of future results. Treat all results as hypothetical. Okay? So, for those of you who don't know me, I'm the author of Building Winning Algorithmic Trading Systems. It has been one of the best selling futures trading books for the past 10 years now. And you can see some of the quotes from pretty legendary trading gurus out there. I've also written 4 other best selling futures trading books, and you can see those. And based on all my experience of 30 years of trading, I think I know a lot of the games that people play in the trading world. And these are just some comments from some viewers that talk about people ignoring back tests, that they're terrible, that commissions and slippage were ignored, that they've seen people over optimize and curve fit. So I just want to go over some of these traps so you can avoid them in your own algo trading. So the first rule I always have is, if something looks too good to be true, it probably is. So if you see a performance report, an equity curve, or some kind of performance guarantee, or anything in trading that you say, man, that just looks too good to be true, chances are it is. And if you avoid it because it looks too good to be true, you're going to be in much better shape. When it comes down to it, nobody's going to sell you the holy grail, the strategy that wins all the time, right? I mean, that's ridiculous. Now, people will sell you very good stuff, very good strategies, but anybody claiming that their strategy works everywhere in every bar size, or their indicator works in all conditions, if it sounds too good to be true, probably is. Okay? So keep that in mind as we talk about these traps, because if you do, you're going to be a lot more cognizant of just what's going on out there in the trading world. My simple guideline is, anything you see results-wise, treat it as hypothetical. So the way I distinguish it, if it happened in your account, then you treat it as real. But anything that didn't happen in your account, just treat it as hypothetical. And if you go in with that mindset that, hey, hypothetical results may or may not happen again, and may not happen to me, you're going to be much better off. Okay. And you might say, well, why? Why are you talking about this hypothetical? Because that's all the results that people show you are hypothetical results. Maybe it happened in their own account, but it doesn't mean that it can happen in your account, or that it would have happened in your account. There's limitations, okay? So these hypothetical results can fool you. And I'm going to talk about some of these traps that we fall into, where we think, oh, hey, this is going to work, where it's all hypothetical and it may not happen. The thing you got to remember is this quote from 1963 by U.S. President Abraham Lincoln: the problem with trading results on the internet is you can't always depend on their accuracy. So you're seeing this on the internet, so it should be a good quote, right? Well, hopefully you get the joke here. All right, so let's look at 4 trading traps, 4 games that people play with trading results. And I'll also give you some tips on how to avoid them and how to overcome them. The first one is curve fitting, over optimizing. One way to do it is when you see these articles of, hey, if the best ETFs of last year, or the best ETFs of the last 5 years, and you think, well, hey, it's been the last 5 years, it's been the best one, so therefore it's got to be a good one, so I'll go with that. Realize what you're doing is a form of optimization. You know what the results were and you just picked the best one. Well, that's optimizing. And that almost never works going forward. So you gotta be careful about this. I used to do this all the time back when I traded more in mutual funds, or invested, I should say, where I'd get a magazine, Money Magazine, Kiplinger's Personal Finance Magazine, and every month I'd look and see which were the hot funds over the last 3 or 5 years. And I said, hey, those got to keep going, right? Well, not necessarily. The best for the last 5 years doesn't mean it's going to be the best for the next 1 month, 6 months, whatever. So you got to be careful about that. Now, with trading systems and algo type trading, this is how it shows up. It shows up as this great equity curve that looks almost too good to be true, right? And again, too good to be true probably will fail. In this particular one, I created this one in about 5 minutes because I knew how to fool the trading platform backtest engine. And it will never work in real time. But you wouldn't know that just from looking at the equity curve. So if you're on YouTube or Twitter or Instagram, whatever, and you see somebody show you that equity curve, you might think you can actually achieve that, when in actuality you can't. So what you want to look for when you look at equity curves is look for realism. And what that means is look for drawdowns. So I have circled some of the drawdown areas, and that helps you understand that, yeah, this might be a real thing. But a straight line equity curve almost never happens. And if it does, it's probably over optimized and it's not going to work going forward. Why? Why is that? Well, the future never repeats the past exactly. So just because you create a trading system that mimics the past and can trade the past, hey, the future is going to be different. So how can you avoid it? Well, if you develop your own systems, limit the number of rules you have, use walk forward testing, make sure you have out of sample verification, and watch it in real time before you start trading it with real money. Don't jump into trading it too soon. Let the strategy prove itself. That's if you create your own system. Let's say you're going to buy systems. Well, just avoid those too good to be true products. Ask a lot of questions. Research the reputation of the seller. And if they offer a money back guarantee, use it if you need to. Okay? So let's look at trading trap number 2. A lot of vendors out there who sell trading systems, education, trading rooms, they'll show you results that do not have slippage and commission in them. And that's a big deal. Here's just a system with and without it. And you can see the performance difference when you add in slippage and commissions. It can be quite significant. And if you're doing any kind of analysis to figure out account size or risk of ruin or what your returns are going to be or your risk adjusted returns, you really need to include slippage and commission. I've heard people out there say, well, you don't need to do it right away, and every broker is going to have different amount of commissions, and that's true, and a different amount of slippage. Well, maybe that's true. The point is, before you make a final decision, make sure you include slippage and commission in there, okay? Otherwise, you're going to get this false sense of profit and loss, and you're going to trade a lot more. So when you don't include slippage and commission and you run a back test, it's going to encourage you to trade a lot, because if you have a little edge, it's going to say, hey, do it as often as you can. But maybe that edge disappears with slippage and commissions. That would tell you to trade less. Bottom line, avoid strategies that have $0 slippage and commission, and make sure you include it for any systems you develop. Okay? All right, so let's take a look at hypothetical trading trap number 3, short time frame. A lot of people like to backtest for 1 month or 3 months, and think, oh, well, hey, it worked the last 3 months, it should work the next month. Here's an example. I optimized over 4 months, and then after optimization, clearly the system isn't the same. It was going up and to the right before, now it's just kind of going flat. That's what happens a lot of times when you have a short optimization period. So I actually ran a test where I wanted to see on a bunch of strategies, just random strategies I had, if I tested over 1 month, was I more likely to be profitable than over, say, 36 months or 3 years? And the results are pretty striking. You can see as you go over to the left and the test period of 1 to 3 months, you can get 30-40% of your strategies being profitable. And what's happening is there's a lot of good luck built in there. So you're getting lucky in effect because it's a short period, and anything can happen in that short period of time. But the longer you trade these strategies, the lower the profitability becomes, meaning more systems, more strategies tend to lose over the long run. But in the very short run, they might actually have some good luck and look better. So if you do a back test only over a couple months, you're liable to get a lot of that luck built into your results, and you're going to think you have something a lot better than you actually do. So watch out for that. So why is that? Well, what it comes down to is the strategy is likely tuned to that short period of market behavior, and then going forward, it's not liable to keep going and keep working. So look for 10, 15-year back tests. Those are good back tests, good lengths to use. And don't do anything under 5 years unless you've tested it on enough strategies. I'm talking hundreds of strategies. So if you've tested with, say, 3 or 4 years back test, and you have 100 strategies that have worked in real time, then I'd say, okay, well, you've got data to dispute what I'm saying here. But if you don't have that data, if you haven't done those hundreds, thousands, millions of back tests, watch out. And that's especially true with intraday systems. A lot of people think, well, hey, if I have 100 trades in my intraday for the last month, that's good enough. And the thing is, you need a lot of market cycles, bear markets, bull markets, big macro markets, to really get a sense if a strategy is going to work or not. But doesn't mean that having a long back test is going to be better. Sometimes those fail too. So just because you have a 10 to 15 year back test doesn't mean you can't screw it up or that it won't give you erroneous results. So watch out. A lot of people think the cure is just run a big back test. It's not necessarily true. Okay, let's look at trading trap number 4. This one's a big one with a lot of fake gurus out there. They will have limit orders and they will assume you're filled when the limit order price is touched. And the reality is that just doesn't happen in the real world. Might happen maybe 20% of the time depending on the market. But a lot of times, if you have a buy order at a certain price, the actual market price has to go below that before you're guaranteed a fill. And one way you can see it is just look at a chart with trades on it. And if you see the system buying at the lows, at the very lows, like over in the left and the right, and selling at the absolute top of a bar, chances are they're using limit orders and assuming a touch fill. Now, take a look at this short one in the middle. You would not have been filled unless it ticked up one more if you were really trading. So this buy, and it looks like a profitable trade, would not have closed out because you didn't get filled on the limit orders. So this can really distort results, and people use this to their advantage because most software has this as an option where you can do touch fills or you can do what's called price penetration fills. So there's a blow up again of that particular occurrence. So watch out for that. And I've seen it turn winning strategies into losing strategies, and it's completely unrealistic. Just assume that limit orders are filled only when the price is penetrated, and you'll be much better off. Okay? And people who claim they can do it, I would run from them. That's the easiest way, because I don't think they have real trading results to back up those statements. All right, so let's summarize these 4 trading traps, or these 4 games people play, whatever you want to call them. But there's the over-optimization curse. There's not including slippage and commission. There's looking at backtests only over a short period of time. And there's the limit order fill when touched. If you avoid those 4 no-nos, or traps, whatever you want to call them, you're going to be much better off. Now, I teach a class, it's called the Strategy Factory Workshop, and I think it's my solution to eliminating those problems, because I teach you a lot of tricks to avoid, because I've been fooled by everything over my 30-year trading career, and you get my personal support in my class. But for all those tricks, my Strategy Factory, the way it's built up, it helps you avoid it. And once you avoid these things, you can go on to be a much better trader. All right, well, if you like this video, just give me a thumbs up, hit the like button, leave a comment, subscribe. I'd love to hear from you. Have a great day. I'm Kevin Davey. Thanks for watching.